What's going on, everybody? Welcome back to another video. Hope you're doing well, feeling great, and enjoying freedom. It's a great day to have a great day. Today, I wanted to talk about why I started buying index funds rather than individual stocks. We're going to get into it, but really quick, just in case you're new, make sure to subscribe for daily videos. Subscribe to my second channel for weekly videos. Get yourself some DYDSS merchandise to help support the channel. Use promo code THANKS for a 15% discount until midnight tonight. It's a Cyber Monday sale. Please move quick. Try out some G Fuel Energy Formula, $5 off your first order by clicking the link in the description. And of course, make sure to go and get your up to 12 free fractional shares by downloading Webull and funding your account. Refer one friend by the end of November, and Webull's going to give you 30 free fractional shares of some of the most rock-solid companies on the planet: Ford, Coca-Cola, Starbucks, Apple, the list goes on. If you refer 3 friends by the end of the month, they're going to give you a guaranteed free share of Apple with a chance of winning all the way up to 20. If you refer 7 friends by the end of the month, they're going to give you 2 guaranteed free shares of Apple with the chance of winning all the way up to 40. Everything will be linked in the description. Okay, so today I wanted to talk about why I started buying index funds rather than focusing my attention on individual stocks. Now, if you watched yesterday's video, I don't want to reiterate all that much, but if you watched it, it was talking about why I started buying stocks, why I got involved in the stock market in the first place, and how for, the last couple of years I've been, figuring out, what type of investor I am. And as it turns out, I'm a dividend income investor. So I'm far more focused on the blue chips as opposed to the non-profitable tech stocks that could offer a ton of upside, a ton of growth, far more growth potential, as opposed to the companies that have already seen their exponential amounts of growth. And they're still growing. It's just more of a slow burn at this point, and they're continuing to do their thing, and they are rewarding their shareholders with dividends. That's how I went about getting involved in the stock market and what type of investor I've become over the last couple of years. But over the last 18 months, I have been focusing far more of my attention and putting much more of an emphasis on index funds as opposed to looking for individual particular stocks. And I'll tell you why that is. And by the way, I still continue to buy into the individual stocks that I buy into. The ones that I own, every time that dividend comes through, I'm throwing the dividend right back in. I'm continuing to build up those positions, but on a day-to-day basis. And when I say day-to-day, I mean literally every single day. Monday, Tuesday, Wednesday, Thursday, Friday. As long as the market is open, I am continuing to make daily contributions into index funds. And the reason for this is mainly because I came across a quote one day that went, "Don't worry about trying to find the needle in the haystack, just buy the haystack." And by that I mean, rather than looking for the best possible stock, they're like, okay, we got the whole S&P 500, 500 stocks, all in one. What's the best one? Where can I get the most value right now? Or what 5 should I pick? Or what 10 should I pick? Got 500 to choose from. Just buy the S&P 500. Instead of looking for the right 1 or the right 5 or the right 10, just buy the S&P. They're all in there. Apple's in there, Microsoft's in there, Amazon's in there, Tesla's in there, Ford, Coca-Cola's in there, Pepsi's in there, Nike's in there. Almost everything you can think of is in the S&P 500. So rather than looking for the best one, just buy them all in one. That's what index funds are. And you can go about building long-term wealth this way in the most hands-off way imaginable. Because guess what? You don't have to research index funds. Everything is taken care of for you. The S&P 500 is the 500 best biggest, baddest publicly traded companies in the United States. And what happens if one of those 500, number 500 on the list, what happens if it begins to fall short? Well, then 501 takes its place by default. You don't have to do anything. You don't have to organize the 500. That's what it is. And by the way, when I say S&P 500, that's just one example of an index fund. You can go for the total US market index fund, which is thousands and thousands of different stocks all in one. You can go for ticker symbol VT, which is the Vanguard Total World Index. Every single publicly traded company on the planet. You can go for index funds specifically designed for only international stocks, nothing US. You can go for growth indexes. You can go for dividend indexes. There's an index for everything. There's an index for the energy sector, etc., etc., etc. This is what I do on a daily basis. There are two that I invest in on a daily basis. And I also set myself up a Roth IRA, which I structured 4 different index funds. There's a 40-40-10-10 split between the 4. Cover all bases. And I contribute to it weekly at this point. And I was doing a monthly contribution, but now I got a second job, which I got specifically so that I could invest 100% of the paychecks of this secondary job, speed up the process, get the ball rolling a little bit quicker. And one thing that I wanted to point out when it comes to index funds is that many of which have the same top 10 holdings. If you go for the S&P 500, if you go for the total US market index, they have the same top 10 holdings. Even if you go for the total world index, I don't remember off the top of my head if they have the same top 10 holdings, but I know they have the same top 3, 4, 5 at least. I don't remember off the top of my head. I don't buy the total world index. But Apple coincidentally happens to be number 1 pretty much no matter where you go. And that's just simply because Apple right now, and for the last couple of years, has been the number 1 most valuable brand in the world. First company ever to reach a $3 trillion market cap. Apple's killing it. Apple's been killing it, and Apple will continue to kill it. But guess what? The people who bought Apple 5, 10, 15, 20 years ago, oh yeah, they're happy. But guess what? Is Apple going to obliterate everything in its past over the next 5, 10, 15, 20 years? Who knows? It might still be number 1, but there might be more growth elsewhere. And the reason I say that is because just because Apple is number 1 right now doesn't mean it was always number 1. In fact, there was a time where Apple wasn't even in the S&P. It wasn't even in the top 500 publicly traded companies in the US. It had to build and work its way into the top 500, let alone the number 1 spot. The reason I bring this up isn't to talk up Apple. It's not to say, oh, iPhones and MacBooks and buy Apple stock. That's not what I'm saying here. What I'm saying is that there was a day Apple was completely off the radar. There was a day where Apple was like a nothing company. There was a day people didn't even know about Apple stock. They didn't even know about Apple the company. They didn't know about their products. Apple started small just like everybody else. So what I'm saying is, there is a company right now that exists. It already exists. I don't know what it is, but it exists. It's not even in the S&P 500 yet. That's how small it is. And one day it will be in the S&P 500. And one day it might very well be in the top 10 publicly traded companies in the entire country. Potentially world. There will come a day that Apple might get surpassed. There's a company right now that might be the new number one someday in the future. I don't know what that stock is, but I do know that by buying the S&P 500, I will have it by default. I don't have to know what it is. I don't have to make any decisions. I don't have to research what that company may or may not be. I will have it as long as I'm buying into index funds. That's why I say this is the most hands-off approach you can take. That's why I say this is the easiest way about going about investing. Individual stocks are fantastic. There is way more upside potential when it comes to growth and when it comes to dividends, passive income, and capital appreciation. But until you know what you're doing, index funds are probably the way to go. If you don't know what you're doing, index funds. If you do know what you're doing, still index funds. Index funds are for everybody. They're not just for rookies. They're not just for beginners. They're not just for particular people. Index funds are for every single person in the world. Individual stocks, on the other hand, requires a little bit more attention. You got to keep up with earnings reports. You got to keep up with management. You got to keep up with sales. You got to keep up with new product launches. You have to keep up with innovation. You got to keep up with growth and expansion and acquisitions. You got to keep up with all of that. You got to keep up with their debt. You got to keep up with everything. You got to pay attention to these things. Now, if you're someone like me and you enjoy reading through earnings reports and you enjoy learning about what these companies have going on and what their plans are for the future, absolutely it's the way to go. But if that's not your thing, if you're just like, dude, I don't care about all these earnings reports, I don't got time for that, I don't even want to have time for that, that sounds boring. If that's you, index funds. Index funds are the way to go for everybody in the world. It's a whole basket of stocks all in one. The S&P is 500 different stocks all in one. The total US market index is like, I think, 2,500 companies all in one. The total world index, thousands and thousands and thousands and thousands and thousands of publicly traded companies all in one. You don't have to do any research. That's what I like about it. So I can continue making my daily contributions into my regular investment portfolio. I can continue making my weekly contributions into my Roth IRA, which is my retirement account. I can continue doing these things on a daily, weekly, monthly basis, dollar cost average my way in. And guess what? My position will continue to pretty much stay in line with whatever the market's doing because I'm dollar cost averaging my way in every 24 hours. Monday, Tuesday, Wednesday, Thursday, Friday. If the market goes down, I buy a little bit cheaper. If the market goes up, I buy a little bit more expensive. And regardless of what the market's doing, my average cost is usually pretty close to it. And that's what I plan on continuing to do. Long term. I do this every single day, and I'm going to continue doing this every single day. It's the most hands-off approach you can take to building long-term, stable, sustainable wealth. And then you can turn around later down the road and do as you please. You can sell. You can continue holding on. You could buy even more. You can pass it down to your kids, your grandkids, your whoever. You can cash out and buy a whole bunch of silver and gold if that's what you want. You can get into real estate if that's what you want. You can friggin' sell everything and buy a Lamborghini and ride off into the sunset if that's what you want to do. It's your choice. It's your money. It's your wealth. It's just up to you if you want to take the hands-on or the hands-off approach. It's different for everybody. I choose to do both. But right now, there's just much more of an emphasis on index funds. I think it's the way to go for the average person. You don't have to be smart. I'm not the smartest person out there. Definitely not the smartest person out there. But you don't have to be smart to invest in index funds. There's nothing you have to do. There's nothing you have to research. You just got to figure out which one makes the most sense to you. Pick it. And that's it. That's once upon a time and the end, all in one. Why don't you guys head on down to the comments and let me know anything and everything related to today's video topic. When it comes to index funds, if you are investing, what is your investment strategy? Are you looking for exponential growth? Are you looking for the tech stocks right now, the ones that aren't profitable at the moment but you expect them to be at some point in the future? Are you focused on the ones that are already insanely, immensely profitable and simultaneously not growing rapidly because they've already seen their growth and now they're just sustaining themselves and continuing to grow? It's like a slow burn. You picking the individuals, you going after index funds. Right now, I like the idea of the S&P 500 being the backbone or the foundation of my entire investment portfolio. I like the way that sounds, and right now it only makes up a small percentage of my entire portfolio. But if I get to the point where it's 20, 30, 40% of the entire portfolio, I'm not mad at that. I want you guys to head on down to the comments and let me know anything and everything related to today's video topic and index funds. If you guys like today's video, please hit that like button, subscribe if you're new, subscribe to my second channel, which is my backup channel for exclusive weekly content. Go and get yourself some DYDSS merchandise to help support the channel. Remember, use promo code THANKS for a 15% discount until midnight tonight. This is a Cyber Monday sale and it ends in just a couple of hours. Please do not miss out. Try out some G Fuel Energy Formula, $5 off your first order by clicking the link in the description. And of course, make sure to go and get your up to 12 free fractional shares by downloading Webull and funding your account. You could deposit as little as you'd like, even as little as a penny. It still works, it still counts. You still get your up to 12 free fractional shares. Refer one friend to the app by the end of the month and they're going to give you 30 free fractional shares of some of the most rock solid companies on the planet: Ford, Coca-Cola, Apple, Starbucks, the list goes on. Refer 3 by the end of the month and they're going to give you a guaranteed free share of Apple with a chance of winning all the way up to 20. Refer 7 by the end of the month and they're going to give you 2 guaranteed free shares of Apple with the chance of winning all the way up to 40. And of course, if you refer a friend to the app that enables crypto trading on the platform, Webull's going to give you $5 worth of a crypto of your choice between Bitcoin, Ethereum, Doge, Sheep, and Cardano. Everything will be linked in the description. Head on down to the comments and let me know anything and everything related to today's video topic. What is your investment strategy and how big of an emphasis do you have on